All right. What's up, everybody? I am super pumped. I don't know if you can see Bill Dallas in the background. Bill, say something and let him see.
Oh my gosh, I can't wait, Dave. This is going to be so much fun.
Yeah. So Bill Dallas has been a mentor of mine for, as long as I can remember in the mortgage business. I was a good client of his back in the First Franklin days.
Man.
Most loan officers that are watching this are like, what's First Franklin? Like, you know, but it was one of the
What's a
all-time.
countrywide? What's a
Yeah,
countrywide? Yeah.
yeah, it was incredible. Bill is a mentor to many of the top CEOs and executives in the mortgage business. He's someone that whether you're a loan officer, whether you're a branch manager, whether you're a regional, whether you're a head of production, whether you're a CEO, follow this guy on Instagram. He says some smart things, and that kind of brings us to the conversation. Well, first of all, Bill, before we start the topic of the key to winning this year, give everybody just new loan officers or executives that don't know you, share a little bit about yourself.
So, started in the mortgage business like probably most of you all, right? I was going to law school at Santa Clara on Franklin Street in Santa Clara and started a company. I wasn't a marketing whiz, so I called it First Franklin. How about that? And went to law school at night, ran a mortgage business, been in it, started it in 1980. And that business I grew up in. And I was a top loan officer going to school at the same time. So I've basically learned the mortgage business probably like most of you, but I've been doing it for a long time. And interest rates went from the day I started my business to almost the first year, it doubled, went from 9 to almost 20. And it was great. Right. And I think being in that, I was able to in 1994, I sold an interest to it, probably one of the first deals in the space, to a company called DLJ, merchant banking. They didn't even call it venture capital back then. And then I bought and sold my business back with a group out of Chicago a couple times. And that got me really from retail into TPO, retention of servicing, creation of products. And so I've pretty much seen it all. And then I started Own It Mortgage, same, after First Franklin. And then I actually been like you, like when you and I met, right? I've done Mindbox, Interthinks, Cloud Virga, all those businesses I funded either through Dallas Capital or myself, but with mortgage people, right? So I think pretty much today, I started Skyline with a group, bought control of it, and most recently took Finance of America public, and then retired in March of 2022, which seemed to be really good timing. So I was pretty excited about that. Finance of America today, public still, but all reverse. So I think part of what I want to talk about today is really some of our reasoning around what we did, and then why, and then I think it has application to what everybody's talking about and doing today. What do we do now, right? What happens next?
Yeah. So guys, I'm gonna put a link. Like if you're watching this on YouTube, there'll be a link down below to this post. And by the way, nice little marketing headline: scoring 24. Bill's got a knack for that. And then he highlights 5 or 6 key things that he thinks, whether you're an executive, whatever seat you have in the bus in the mortgage, how to score in 24, like how to thrive and gain market share right now. So Bill and I are going to go through this list, and I've got some color to give along the way. So Bill, let's rock it out.
Let's
Rock
go,
it out.
babe. Let's do it. Yeah, I think one of the things that you have taught me is just how important it is to be clear. Like in this case, right? I think we've got a wide audience because you will have CEOs, you'll have people who run mortgage business. what I love about this is the mortgage brokers, they all run their own business. So they're all entrepreneurs, right? And then you've got people that work in the industry. So it's applicable to all, to everybody.
Agreed. Agreed. So what's the first strategy and why?
DLM, baby. So my clients depend on me to really help them. And so I think one of the things that I've learned about mortgage is the same. I'm going to stay with football for a second, just because we had the Super Bowl, even though the Niners lost.
That was unfortunate, by the way.
That was unfortunate, but they almost deserved to lose, right? Not only did they not understand what the hell was going on in overtime, because there's no way you want the ball first in the new overtime rules. But let's just stay with this. So there's ways to score in football, right? So let's just think about it. You can get a safety, it's 2 points. You can get a 1-point conversion, it's 1 point. You can kick a field goal, it's 3 points. And you can score a touchdown at 6. So these are in order probably of points that you could actually get. And there's many ways to score in mortgage banking, right? But you have to score, right? And so my chief ways, chief, I better not say chief, my Niner ways to score in 2024, no pun intended, really starts with the 6-pointer, right? Which is don't lose money. And the problem with mortgage is that they just don't stop. Every company I talk to and almost everybody I see have more excuses and are trying to produce their way out of this problem. And a real good friend of mine, Scott McAfee, who used to run Security Pacific Bank and then a little bit of B of A. He also had a subprime or a firm that we were close to in our area. He was on my board for a period of time, and he said one really cool thing. He says $1 of loan production may be worth a penny, while $1 of an expense removed is worth $1. So I think what mortgage companies do is they're built on production, and they're not built on understanding their fixed cost structure. And what happens is as these companies get bigger and bigger, they lose control of fixed cost. And 70 to 80% of all fixed cost in the mortgage business is people. And all those costs have gone up. You see layers upon layers. I see companies doing $1 billion a year that have a complete structure of people. They have regionals, they have a head of production, they have branch managers, they have people who report in. So you've got this massive structure that needs to quit. So don't lose money is number one.
So Bill,
I think, and it's worth, I'm going, that's a touchdown, right?
And before we go to the next one, go finish this one, but don't go to the next one until I have a question and a comment.
Yeah. So I think that's probably the biggest one that I see in the mortgage business, Dave.
So there's no doubt you've got to, make the right cuts for sustainability. But I also feel, and I just want to get your validation on this, that they don't put enough emphasis on efficiency. The industry celebrates volume, how many loans did we close, how much volume it is. And they scorecard that, like loan officers are scorecarded on how many loans they close, boom. But they don't scorecard conversion, credit report versus closed loan.
Mm-hmm.
And they don't scorecard as effectively as they could on concessions.
Yes.
And usually like when you look at loan officers, like the highest conversion with the least exceptions are the most profitable. And I don't think companies put enough, they don't measure it as effectively as they could, and they don't implement technologies that address that like they should. Any thoughts on that?
I think it snuck up on them a little bit, right? Because not only did we Dodd-Frank our way into compensation plans and rules that allow us to only really get paid the same amount on no matter what loan we pretty much do. The other piece is, we got saddled with concessions because it used to be shared, and we got saddled with all these TRID cures. So you had 3 major, and then every one of these companies have been sued pretty much. Labor law is terrible. It's very hard to manage. So almost all of them have suffered from those big compensation things. And then I would say probably the headline here for you and I, which I'm more of a disciple in Trust Engine, all the things that you guys have done for years at MortgageCoach and everything else. I think what surprises me is that tackling the loan officer and the P&L branch structure, they've just failed at. Right.
Yeah.
So, and it's a lack of focus on the core problem, which is right under our noses. The loan officer is not productive. Right. And so what we have to focus on is the problem begins, like you've always said, where does it begin? With the initial loan officer, their training, and the borrower interview. And
Yeah.
how do you do that? So I think the loan officers need to be trained differently. They have to have tools to complement. How do I become more efficient? How do I retain the customer relationship? Because it's much cheaper for me to do my next deal with that customer than it is to get a new one. But our industry is sort of built on new. It's built on purchase, built on new. I need a new customer. And why? Because that's how we get paid.
Yeah. Well,
we do exactly what people tell them.
And it overly emphasizes volume. You and I talked after I did the Moneyball interview with Jim Deitch, I believe, and this is an anonymized case study of a typical IMB. Did you and I go through this on one of our past interviews?
We talked about it, yeah.
Yep. But this is tier one loan officers. It's not how many loans they closed. It's what's their profitability per loan. And tier two, Jim says when he does this, sometimes they're up a couple hundred, sometimes they're down a couple hundred, but they're not killing us. But it's the tier three loan officers that are causing these forced mergers. They're putting companies out of business. They're robbing. And when I asked Jim, what's the difference between this and this? It's conversion and it's concessions. I mean, to your point, like this is actually the funnel from this particular lender. And it's showing like, hey, they're losing 45 basis points from withdrawn loans and fallout.
Mm-hmm.
They're losing 40 basis points from, concessions. They're losing, like they're not making 100 basis points.
No.
But most mortgage companies, because they're not as efficient as they could be, are losing 20, 30 basis points that they could, if they just implemented the right technology and they train their loan officers, they could fix it.
And I agree. I think probably the things that, I like the word trust, right? And I know when I was a loan officer, I could establish trust with the customer in a few minutes, right? By the way I convey what I wanted to discuss, how I approached what they were trying to accomplish, right? And it was somewhat of a financial planning discussion because if you're going to buy a big asset like a home, you better understand what to do with it, right? And so
Right.
I think the tier one, to a big extent, maybe even a little bit of the tier two, they know how to do that. They establish trust. They use tools like your tools. They use others. But at the end of the day, they really are good at that. I think the other thing they're really good at is they're good at organizing and processing the file in a way that it can actually get into a system. Right. And the tier two and the tier three people are like the 101 and the 405 in LA, right at 3:30, right? It's like all hell breaks loose because people are going in and out. Nobody knows where they're going and everybody tries to avoid it. Yet we keep hiring people that don't fit, and then we don't understand our process, right? So I think don't lose money. I mean, the cost of manufacturing can't go from 5,000 to 15,000 without multiple touches, multiple people, and a very poor process. And it all starts with your LO taking a good application, that application getting in the stream, and they understand the app, they've told it, and it's going to convert, right? Because if it doesn't, I mean, everybody in January, in the end of December, first part of January, tell me how much their apps are up. Who gives a shit? Right? I mean, apps aren't locks. Locks aren't funding. And what you're seeing, what you will see is, that was probably a high propensity of refis, cash out potentially seconds. I don't think people do near enough. Like you said, if I'm going to examine profitability, I have to examine profitability per loan type and loan size, number of units, all those things, and branch. So if my branch manager, like you and I have talked before about doing this, if a branch manager is going to be the king or queen of production for this area, then they have to be able to manage their P&L and understand the value of different types of loans and what they create, even though their LO is paid one number, right? So I think don't lose money is manufacturing, it's touches per file for lenders, it's making sure that you have just the right tier 1 loan officers. And if you're going to have a tier 2 and tier 3, what's your goal? It's to get them to tier 1, right? Yeah. I don't want tier 2 and tier 3. I want one tier. And you don't want your staff running around chasing PTD conditions, trying to fix an ugly freaking loan, right? That's never going to fund, right? And so I think that is 6 points. That is the problem. And we then trickle into technology a bit. Well, you can't automate a broken thing. You got to fix the process, and you got to have everybody on that process in order for it to work. And so part of what I do with most of my companies that I work with and CEOs is, how do you do this? Right? Just, how can you make this quantum leap? And it first is weeding the garden at home, just making sure that you have the absolute best people. And, the other piece is when you start laying off people and going through all those processes, you could have all hell break loose. People heading to different companies, and right. So it's a very slippery slope, I guess, for most people.
All right. Number 2. What's number 2?
So I think focus on value, on adding value, right? Because let's go big picture, another 6-pointer. So what is, and I say this all the time to people, I mean, your business, look at the last 3 or 4 transactions that have been done in the mortgage business. Let's take Academy, let's take Academy and Cherry Creek, right? Your guild focus. And then you had the mortgage network going to Casey's business. So when you look at those, all 3 were earnouts. 0 value given to the company. None. I don't want your stock. I don't want the company. I want the people. I want selected assets. I want them to be able to produce, and that's how you're going to get paid. Okay. Let's just stop for a second. You didn't work your whole life for that deal if you're a mortgage banker, right? So how can you build value when you sell servicing and you can't really retain the companies, the loan officers, and you're not making money, right? So I think one of the things that I've tried to say is, and you've been consistent with it, the number 1 miss in mortgage is first servicing, right? Once we unbundled servicing from the asset, you have no asset that you've created. So really, when they look at your balance sheet, they'll look at your book value of the company, and then they'll look at basically no other asset. Everything else is a liability. LOs, leases, comp plans, space, technology, all these things. So you have to figure out that the number one asset is really the customer and the retention of the customer, even though you're selling the servicing. So how do you do that? And so I spend a bunch of time trying to make sure that we, like even in your case, right, with MortgageCoach in the old days and trust, how do I retain the customer? And I think I posit to each of these companies, I say, if I'm a lawyer or I'm an architect, or let's pick, I'm a if I'm a contractor, I will have you sign a document that says you're my customer, and I'll do an RFP. I'll tell you, like, if you want me, I have to engage with you. We don't do that in mortgage, right? I think it's the biggest miss. So why don't you immediately sign the customer up? Get a signed document that says this customer is mine. You can charge them. They can, you could create all kinds of ways to do it, right? And so what I've done is I've created this what I'm going to call, for one of anything else, a home. And you can only use two terms in mortgage. You could only use home advisor or home equity advisor. Maybe home services, but home services gets cloudy because we don't do home services, but you do manage home equity. So what I've done is created a document. I've given it to the companies and said, look, every loan officer, especially tier one people who talk this way, everybody talks about the relationship and then they act transactionally. Sign the document. Sign your customer up. Now think about this. If I now have sold the servicing and I have 10,000 customers signed up under contract, is that valuable? Yes. So I've just created value, and I've dealt with the most hideous problem in mortgage, which is origination unbundled from servicing, which is just doesn't make any sense to me. And now, could we afford to retain servicing? Everybody's trying to do it, but pricing and all of that forces you not. So adding value, I think, to a mortgage company is retaining the customer, potentially retaining servicing, making a profit, and figuring out some way to probably share that wealth with that group so that you can retain these loan officers for a long period of time. That's two. That's 12 points, and we didn't even kick the extra point yet or do anything else.
It's all good. By the way, you mentioned a letter. Is that something you're willing to share?
Sure. Yeah, so, it's mine, right? Okay, so it's a legal agreement.
We'll make sure it's yours. Yeah. We'll put if you're watching this, there'll be a link down below in our YouTube channel to Bill's letter.
And what it does is it gives, if you follow, I'm going to give you a good example, like Fisher Investments, you see on TV a lot today. Mm-hmm. And you compare that to, I don't know, Merrill Lynch, Charles Schwab, it's a difference, right? So what have they done? They basically said, we're on the side of the customer. We only get paid when we do something that the customer wants us to do. And they have a list of things that they do. So I have what I call 10 commandments or SLAs, or 10 things that we commit that we're going to do. And I think to consumers, they like it. Could you charge for it? I could charge for it. When I started my business, that's how I did it, right? I did real estate and I did mortgage, and you signed an agreement and off we went. Or I didn't do any more work. Why in God's name do I want to do a bunch of work with you out shopping, on the shopping network today, HGTV and Zillow and everything, Redfin and everything else that people have? You've lost total control of this customer. So that's number two. So, and interpreting this for every loan officer listening to this, he's saying, make your database your number one priority. Your number one. If you made your database your number one priority, if you executed really well, leveraging the Trust Engine platform, using your CRM, delivering every family advice with price, number one, you'd have
pretty much residual business. Like you'd have predictable loans. Obviously, the lower the rates, the bigger the spigot, the higher the rates, but it's predictable. And
Yep.
then two, you would have more leverage with realtors. You would have more leverage with everyone. So, I mean, it really is making your database, making the experience that you give a borrower at the point of sale your number one priority. And magic happens for both the loan officer
Yeah.
and for the C-suite.
Yeah. And I was, a quick sidebar, right? I was trying to recruit a guy in Westlake, and he's top LO, been with a couple companies, but he grown up at Prospect Mortgage and loved the guy. And every night, it was so funny. Every night he basically had a USB that he would download, and he went home every night with his customer base. He didn't even want it to be on in the cloud or at the company, because something could happen, right? And
That's
I'm
taking it a
telling
little
you,
far. That's taking it a
it's a
little bit
little
far.
far, but at the end of the day, I'm
It
telling you
makes the
what,
point.
when rates ticked down a little bit, he was inundated. He didn't
Yeah.
have to do anything. It was just like boom. And this process, like you said, the process of constantly being in contact with your client, and they are your trusted client, and they want to listen to you, I think gives you because I think that the space between, and we're seeing that space today, between an actual closing at a lower rate and then their next deal, that could be too wide. So you need to create more at bats for yourself in other ways. And you're never sure when a client's going to sell their house or get divorced or have a problem or have a baby, or I mean, all the life
Or want to
events
help their
things.
kids buy a house,
Yes, you just got to be there, right?
yeah, yeah. No, you need to optimize. And not that I'm gonna do a little trust engine commercial, but anyone listen, I mean, that is what
I love that.
we do. So what's number three?
Three, I'm going to kick a field goal. This is not quite as important as the other two. These aren't 6 points, but maybe it's a field goal plus a safety, so it's 5 points.
I'll be the judge of
But
that.
yeah, build relationships that produce leads, right? Because you've got all the social media and you've got all these other things. And I think what branch managers and loan officers need to be doing all the time is they need to be in the presence of a lead source. And so I call this, I'm having customers with borrowers, and I'm having customers with folks that could potentially give me relationships. And being a trusted mortgage advisor or a subject matter expert is much better than being a good salesperson with a little bit of knowledge about the loan business, right? So how do I do that and do it well and stay in the presence of the lead source? And so the first thing that I say is, we call this the TAN, the Trusted Advisor Network. And the Trusted Advisor Network starts with your existing customer base. It then morphs into anybody that you know. It then moves to realtors, financial planners, accountants, CPAs, attorneys, builders, blah, right? So there's a wide swath of people that could potentially say to you, you're the expert. Now, my own personal journey, if you're interested, was I listened to somebody tell me I can either try to go find one realtor at a time, and if I build that relationship, I could get some loans. And I said, that sounds too freaking slow for Bill, right? I just was like, there's got to be a better way to do this. So what I did was I went to De Anza College at the time while I'm going to law school and created 2 classes for them. They didn't even have these classes. Nobody was, you didn't have to take classes to be licensed back then. And I created finance and principles, right? And so for about 15 years, I taught that class, right? Twice a week, along with going to law school, along with running my business. And it was exponential marketing. Because now I'm seeing it started with 15 people. Then once they came to the class, they told everybody. So by the time I was done, I had a couple hundred people. They had to build a classroom where people could come because there were so many people. And I used to take attendance. I just went, guys, I'm blowing up attendance. You either come, if you want to sit up front, you get kudos, maybe some spit or something that I might do, but we're going to have some fun. And what we taught them at the time, the whole class, was around how do I buy a house with no money down? And they just ate it up. I became the expert. My company grew. Half the people, if you got A's, I probably figured out I should hire you, right? But everybody was a potential customer. And I didn't even, today, where's that database? I don't know. There was nothing to retain a frickin' database back then. It was just, right? So I think exponential marketing is a way that you think about it, especially as you're growing your business. So produce relationships and build relationships that produce leads. And like you would say, there could be a tier 1 lead, a tier 2, a tier 3, but relationships are, we focus sometimes too much on loans. Loans only come if I've got a big, like you said, I have a big funnel and a lot of stuff going into my funnel. So that's 3.
So, and just a couple notes on that one, guys. So Bill, I built this webpage. It's called trustengine.com/10x for producing branch managers. Because I really feel like the producing branch manager is the most important person. One, they're doing volume, and 2, they're the responsible for the success of their other loan officers. So out of all
the hardest job by far. A player coach is the hardest job because you're competing with your players and then you're helping them at the same time. It's very hard to do.
Yeah. So anyone watching this, if of all the interviews, and I interviewed hundreds of top performing loan officers and executives last year, the ones that I thought were most important from just a sales training perspective are right here.
Yeah.
If you want to focus on winning with realtors, these are the top. And if you want to win with shoppers, these are the top 3. You notice Daniel Saw made all 3. I don't know if you know
look
Daniel.
At what he closed.
Do you know Daniel?
Yeah, a little bit.
Yeah. So, but and then I also have, for all you branch managers, regional leaders, this is the VP of sales for Daniel Saw's 40 loan officer region, which in Columbus, Ohio, became the #1 market share leader.
Buckeye, man. Yeah, come on.
Yeah. He took out Huntington Bank, who was previously #1, and Rocket dropped from #2 to #3 in Columbus, Ohio. So if you want to producing branch managers, I'll put a link down below. That's our 10X webpage to help school you up.
Let's stay there, and I'm going to kick it. I'm now going to move to an extra point or 2.
Okay,
right?
Let's go.
With what
let's
you're
do
doing.
A 2-point conversion. 2-point
All
conversion.
Right, 2-point conversion, because this is a big deal, right? Don't hire new LOs. Get LOs to do more.
Boom.
So why are you trying to go out and hire a bunch of new LOs? If you're a branch manager, you only have 2 things that you could do to grow your business. One is recruit and bring in other people. The other is create leads and relationships so that you can attract more people to want to come work with you. The third is then just make sure that your company's operationally excellent so they can fund the stupid things if you actually can put them in the system. So I think get LOs to do more loans, don't hire more LOs is sort of secret sauce. Because and that goes back to #1, which is $1 of production could be worth a penny if you're making money on each loan, right? But if $1 of cost savings is $1 of profit, right? If you can do that. So I think with your software, with putting the loans in the system, which being, I think loan officers can save 8 to 12 hours a week doing 5 or 6 loans, a month, by cleaning up their ugly loans, not understanding what they're doing. And that's a tough job for a branch manager to train these people as life is sort of going on. Because my experience with it was, okay, there was Bill doing 50 loans a month, and then I had 50 people, other LOs doing 50 loans a month. I was like, what am I doing? Well, I wasn't managing them. I wasn't spending time with them. My business didn't grow until I hired 2 LOAs to do all my loans, so I could spend more time running my business and then working with these folks to help them and train them, because it's really closing ratio. And if you think about mortgage, I mean, we've got this built-in 20% that we just throw, we take 80% out of 100% of our apps, 70 to 80% of them fund today. So 30% go away, 20 to 30% go away. So what are you doing with that 20 or 30%? That's actual customer. I guarantee you, if a tier 1 person talked to that 20 to 30%, what do you think is going to happen? Probably convert eventually. But the tier 2 and a tier 3 person, they have no idea what they're doing. And if you don't want to be in charge of a daycare or a hair salon, or merge the two, a daycare hair salon, right? You better be a good branch manager. And that means constant huddle, constant training, constant retraining, constant discussion, because I think most of these branch managers were just good loan officers. They weren't good leaders or managers of people. And that's a tough thing for them to do. And you're, like you and I said, you're competing with them for resources, and you're providing resources to them. And I think producing, non-producing is also, so one of the things that we've always tried to do is have 2 different tracks of training, because non-producing people generally are really good at recruiting or better, and they're very good at creating outside relationships that attract people. So when I'm talking to mortgage companies today, I'm saying I start with this, which is, what differentiates you? Why would I mean, every freaking mortgage banker in America sells the loans the same 3 spots. We all have the same freaking products. We all have, everything's the same. We all use Encompass. We all use this. We all blah, 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 right? It's like, so why come to work for you? What's the difference? What, we're nice people? We won't go under? We got plenty of capital? We're boring? What? I don't get it. So I think the number one thing that a branch manager should do is, like you just said, putting that 10X thing back up. You know, when I took over at Finance of America, all my focus was on 2Xing the people that I had, providing them the tools and the things that they needed to be successful, and then managing them. So we started with a 1-page production plan. We called it an OPPP, right? It was just, everybody had to have one. Dave, what are you going to do next year? How much production? What do you want to do? Right? And that could lead into their personal life, their financial life. All of those things are integrated. So I think, and that allowed us to invest in the people that really wanted to grow with us, and it allowed us to understand them better. And it focused us on 2Xing them versus trying to go out and hire. Oh, I've got a complete unit, and what they do is they hire new loan officers. Okay, I don't know about you, but when I used to run a real estate company, every realtor thought when I brought in a new realtor, the pie got smaller, not bigger. Well, I tried to sell them on the idea that, hey, this person, we got a bigger pie. You're going to get a bigger slice. Nah, they ain't buying that. So I think that is, get LOs to do more loans. Don't hire more LOs. And I tell every one of them, out of the people that you've got today doing 1 loan, if they just did 2 loans this month, Did you just balance the federal budget? Yep. I
Yeah,
just made February a winner, right?
and they can all do it. I mean, by the way, that microsite that I showed you, the Mortgage Coach 10X sales training, when I kicked that off, it was like literally to get every loan officer this month to be able to do one extra loan, and to be able to help every loan officer this month recruit one more realtor. And guys, by the way, Bill, first thing I don't agree with is that is not a 2-point conversion, bro. That's a touchdown.
A little
Like,
bigger. Yeah.
because think
I
about
tried to
it.
give it 5 points or 6.
Well,
Maybe we just,
if you
but think about Dave, how hard a 2-point conversion really is, bro.
yeah, it's not.
How about no? How about this? How about it's an onside kick that we recover?
A touchdown is harder. And by the way, to get and actually upgrade your loan officers and actually 2x your loan officers, not an easy thing to do. Like, this is not easy, but if you can do it, think about what that's going to do to your retention of your loan officers. Think about what that's going to do as far as making you a magnet from a recruiting perspective. And so, by the way, we posted this blog post yesterday. Our team wrote up. I'm super proud of it because a lot of content you see, it's like the art of selling. And our team put together something. And Bill, I'd love for you to
really
scan
good.
this, read it, but really walk through and write a very data-driven article around what are the skills of high performing tier 1 loan officers. Guys, here's some data, guys. Like, there's still 324 loan officers closing over 300 loans right now. There's a lot. There's 900 closing 200 to 300. There's 6,000 closing 100 to 200. So now there's a lot less of them having that kind of success in this market. But you know what all the most successful loan officers have in common? They're doing everything Bill says. They're adding value. They're building clients for life. They're leveraging their tech stack to stay in front of their customers. They're monitoring their database with Trust Engine and pulling every opportunity out of that database they can. And then when they do get a customer conversation, they're delivering advice with price, not just price.
And they're getting them to sign the document.
All right,
they own the customer.
I haven't seen the document yet, but we'll weigh on that later. So number 5. What's number 5?
Offer. So I think the biggest miss in mortgage has always been there's two major misses, and they're both product driven. So I think offer loan products that help folks get cash out and help folks invest in more real estate. And the mortgage business is built around what? A primary occupant, owner occupied, probably purchase money, first time home buyer. I mean, that's basically agency 101, right? Fannie, Freddie, Jenny, all around it. What do they not like? They'll do rate and term refis. They don't like cash out. We don't do seconds. We don't do any non-QM loans, which could just start with the 2 best non-QM loans today, a HELOC and potentially an IO. We don't do any of those, right? So my view is that there are many, many mortgage products that mortgage bankers don't do well. And so the first is to get cash out, and the second biggest miss, I think, in history of mortgage is non-owner occupied, right? Because so I've made most of my career around whatever the agencies orphan, I take. So when the agency started to orphan, really cash out, second homes, non-owner occupied, condos, prefab, non-QM, DSCR, just line them up, right? I think that's our biggest miss. Now I'm going to add 2 others to it today, which if you really want to do this well, you've got to offer reverse. You got 15,000 people a day turning 62. So you've got to understand reverse, and you got to offer it, much like you do a VA loan. And I think the next big thing in mortgage is going to be an HEI. And most people couldn't even, what is an HEI? It's a home equity instrument, right? And I think you're going to find, because there's so much equity and people can't afford a payment or don't want one, there's going to be more and more conversion of HEIs. And it's a brand new field that I've spent the last really 4 or 5 years working in, trying to figure out, because I actually think if I had this suite of cash out products, mortgage bankers don't have it, and that's why they're suffering. They don't do seconds. They suck at HELOCs. They don't like this. I mean, they can't. I mean, I just think it's the biggest miss ever. So products.
Well, one of the
That could be
things,
another 6. To me, I'm a
no,
product
that's
guy.
another, it's a 6. You know, when I studied Rocket's retention, you know, and the amount of retention, a big part of their retention story is the fact that they offer so many different products to a consumer. You know, and I do think, you know, distributed retail, you know, everyone, like you want to get a customer, you want to help them with their second home. You want to help them get investment properties. You want to help them leverage their equity and help their kids buy their first home. You know, you can help your kids buy a duplex or a triplex, and that could pay for college. Like if you really help people strategically understand how to leverage their equity, and achieve their goals. And again, the real American goal is not just home ownership, it's
No.
home ownership with financial freedom. And
Yes.
everything that you said powers that vision. So
Yeah,
I
and you
I
are
agree. It's a touchdown
home
run.
advisor or home equity advisor. I think the first big miss in home equity advice is if you just made one extra payment a year, your loan pays off in 19 years.
All right. Number 6. What's
All
our number
right.
6?
So this is I'm going to go to I'm going to use now Darrell Royal. You know, I hate University of Texas. Sorry, Texans. I'm a Dallas. I should love it because I am the namesake for the city. But Darrell Royal, who was a great football coach at the University of Texas, had a saying that a lot of people, you can look it up, right? It's dance with the one who brought you, right? And what I see people doing is the yard over there looks easier to mow than the one that I'm in now. And what you're seeing are people doing things that they aren't very good at. And I think my point would be, look, in times of trouble, or when things are tough, consolidate back to your core competency of what you are really good at, because you will do that better. And as anybody will tell you, what you're passionate about, what you do well, and what you can make money at is your model. So I think it's tough because I see people going diversions to try to solve the problem by not focusing on dancing with the person that I actually brought with. And I think I hear that more today from LOs than ever before.
Really?
They just are frustrated with their company. They don't get information. They don't understand it. The number one complaint that I hear from an LO is we are so fat that they have to add all this pricing, and our pricing sucks. Okay, come on. We all get our prices from Fannie Mae, Freddie Mac, and Ginnie Mae. So the only thing that could lever that is a view of what you think the servicing is worth, or a view of what it costs you to produce the asset. So my view is it takes, and I spend a little bit of time, I'm an Angela Duckworth convert with the word grit. And this is you just have to do it better, right? The problem is under your nose. You'll figure out the best way to fix it, but only do things that you're really good at and don't try to do something else. And what the University of Texas did, they just ran it up your butt. They just run the same play. We're going to tell you. In fact, they used to say, we're just going to tell you, we're going to go student body left or student body right, or we're going to run it right up the middle. We're going to tell you what the play is. You can't stop us. So my view is there are some innovations and things that you can do, but at the end of the day, you want to be able to figure out how to do this better versus trying to do something else or expand. And people ask, where do I begin? Right? When I come out of it, because everyone wants to change the game or do something else. So where do you begin? You have to begin with knowing exactly what you want to accomplish, but you got to fix what's inside the organization first. So don't lose money, just stop, and then begin to just layer these things and have a conversation with your staff. Right? As a leader, my job is to constantly talk about these 6 things that we're going to do in 2024 so we can be more successful. Because what I don't want to do is when interest rates drop, and they inevitably will, production will rise, and you aren't going to be prepared.
Yeah.
Right? You may do more loans, but you're not going to be able to transform this business. You got to do it now. And so it's like I've always said, I wish, like my clients, I spend a lot of time boxing, going to the body. I don't try to hit a knockout punch. I just keep hitting them in the stomach, right? Until they fix their broken engines. And I think coming out of 2020, I mean, I actually had this conversation with Casey Crawford a while back, and we have a great relationship conversationally about our businesses and our philosophies and everything else. But it was, he'd always said, and I would always say, I've seen everything. I've been there, I've done that, seen it. And he basically said it, well, what do you think about this COVID thing? And I have to say, this is the toughest environment in my career that I've ever seen. I mean, we've never seen interest rates go from 3 to 7 and each point a Richter scale. The volume shut off after 2 years of just, right? And you look at all these companies, they've all given back most of their servicing. They've given back most of their cash. They're merging, and there's no reason for it. You can sustain this. You just have to run your business.
Well, my man, this has been amazing. I am looking forward to seeing you at Momentum Builder next week. And I know coming over to your house on Monday night, Tuesday night.
Tuesday night.
Look forward to seeing you there.
You too.
These 6 things are amazing. I just can't emphasize enough from my perspective, if lenders put more focus on getting more out of your existing loan officers and really putting process, people, and measurement around it, not just like, oh, we got a webinar this quarter, we're going to do a bunch of sales training, but no, if like you started measuring conversion, if you started scorecarding concessions and you really started celebrating the loan officers in your company, not that are necessarily closing the most loans, but the loan officers in your company that are the most efficient and that are doing modern things. Like, guys, I literally think every lender in America can like be profitable like in a quarter.
Well,
you could flip a switch in a quarter, and
oh my gosh.
By the way, and it also doesn't necessarily require cutting people. It requires getting people to do the right things. Again, if you are watching this and you want to learn more about Trust Engine, email me, Dave@TrustEngine. Make sure you follow both Bill and I on LinkedIn. We try to do our best to be valuable, not be busy on social, but deliver business value. So, Bill, I really appreciate you, brother. Thanks for being a good friend and making time for today.
See you.
See you soon.